Alibaba just released their latest quarterly figures. It was a revenue miss and a small EPS or EPADR beat. Right now, the time of making this video, the stock is down 2.4%. Over the last 3 years, it's quite astonishing to see that Alibaba is still down 56%. Year to date, the stock will be up 3% or so. It has a market cap of $188 billion and a forward PE of just 9.4 times. Now you might say, yeah, it's okay, it's normal because there is China risk, it has not been growing that much, profitability side of the business wasn't great, China economy, lockdowns, etc., etc. Okay, fine, but should it be this cheap, right? Compared to its 5-year mean, should it be this cheap? 9.4 times forward PE, 5.9 times EV to EBITDA, price to sales 1.3 times, price to free cash flow 9 times, and then price earnings to growth under 1. I mean, it is very, very cheap, even if it is a Chinese company, right? And over the last couple of years, they have been buying back shares, so they are returning value to shareholders, although the stock did not move much. Shares outstanding are down 12.3% in the last 2.4 years. And despite the stock's performance, it's not like this business has not been growing, right? Revenue is up quite a lot in the last 5 years. Gross profit is up. It's true that the problem has been the profitability side of things. So you see, net income has come down, one, because of the lockdowns, the pandemic, and then the rebound has not been as great as some of its competitors, like JD, like Pinduoduo. By the way, JD, I believe, reported earnings as well, and they reported record high net profit. So definitely an increase in competition is hurting Alibaba. And if we currently look at the average analyst price target, sits at $107, 34% upside from the price we're at today. And by the way, since 3 months ago, since the last earnings report, nothing has changed. The stock price hasn't changed, and the average analyst price target has changed by $2 or so. I believe previously it was 105. We're now at 107. So nothing has changed over the last 3 months. Now, before continuing, if you enjoy these type of videos, leave it a thumbs up, subscribe if not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's start with a couple of comments here. Our results this quarter demonstrated our strategy at work. Our focus on enhancing user experience by offering quality products at attractive prices with great service led to stabilizing market share of Taobao and Tmall Group as we returned the business on the growth trajectory. The cloud business achieved positive revenue growth momentum driven by public cloud and AI-related product adoption as we continue to invest to maintain our market leadership. In this quarter, we continue to invest for growth in our core businesses while reducing losses in other business units through operating efficiency. We maintained the integrity of our margins and delivered consistent adjusted EBITDA. We also returned significant value to shareholders at a pace higher than past quarters, as we made $5.8 billion of share repurchases that included a concurrent repurchase of shares in connection with our convertible notes offering. The transaction underscores our confidence in our business outlook. By the way, remember there was also a whole restructuring thing, right? Splitting it up into a couple of businesses, IPOs. Well, there have been some delays as well, so you have to remember all of that. And so looking at the revenue breakdown, Taobao and Tmall Group, this is basically in China, so that's down 1% year over year. China Commerce Retail is down 2% year over year. The Cloud Intelligence Group is up 6%. So that's already a positive because it has been growing quite slow, I believe 2% and 4%, so not by much. China, the logistics side is up 16% year over year. Local Services Group is up 12% year over year. As for international, that continues to outshine. So international commerce retail is up 38% year over year. So overall, revenue is up 4%. Looking at adjusted EBITDA, net income, and free cash flow. So free cash flow, by the way, is down year over year. We're now at $2.39 billion, down, I think, 50% or so. Adjusted EBITDA is down slightly, now just over $7 billion, and non-GAAP net income is also down a little bit at $5.59 billion. Now, they did say here yet again that the net income decrease of 27% year over year was primarily due to a decrease in income from operations and the increase in impairment of their investments, partially offset by the mark-to-market changes from their equity investment. They said the same thing last quarter. And non-GAAP net income, as we just seen, that was a decrease of 9%. And so looking at the different segments of Alibaba and then adjusted EBITDA and the changes year over year. So the revenue change we have already seen. As for adjusted EBITDA, Taobao and Tmall Group, adjusted EBITDA is down 1% year over year. The Cloud Intelligence Group is up 155%. But then the Alibaba International Commerce Group is down 782% on an adjusted EBITDA basis. The logistics network is down 30% year over year. Local services is up 81%. And so all the others are up 27%. Overall, you're down 1% adjusted EBITDA year over year. They say here Taobao and Tmall Group is winning the mindshare of their customers. This past quarter, they achieved high single-digit online GMV growth and double-digit order growth. As for Alibaba's overall revenue, excluding Alibaba consolidated subsidiaries, grew at 6%, driven by double-digit public cloud growth and increasing adoption of AI-related products. Alibaba International Digital Commerce Group continues to achieve robust revenue growth driven by rapid order growth in cross-border businesses, especially from AliExpress Choice, which is basically the equivalent of Amazon Prime. A little bit more information on the Taobao and Tmall Group segment. So the number of 88 VIP members continue to increase by double digits year over year, surpassing 42 million during the quarter. We aim to enlarge our pool of premium shoppers by continuing increasing the subscription of 88 VIP membership and enhancing their purchase willingness through improved benefits and services. And so overall, we've got here Consensus Guru again with the beat or miss. So they missed on revenue by 2.4%, China retail missed by 3.6%, international retail missed by 3.1%, smart logistics by 5.8%. All the rest here basically beat other than free cash flow. Free cash flow was a miss by 54%. But you've got gross margin a beat by 253 basis points, EBITDA margin a beat of 189 basis points, and EPS a beat of 8.9%. So that's quite good. But the free cash flow part, they basically explain it by this. The year-over-year decrease mainly reflected the increase in expenditure related to our investments in Alibaba Cloud infrastructure and other working capital changes related to factors including our planned reduction of direct sales businesses. I mean, okay, fine, but how can analysts miss this big, right? The difference is 54%. You're going to tell me that none of the analysts knew about this? None of the analysts expected this to happen? This is not a small, this is not 5% miss. This is a 54% miss on free cash flow estimates. It's quite a big one. And so looking at the graph right now, like we've seen before, we're down 2% or so, 2-3%. We did make higher lows, right? Since the end of 2022, did make some higher lows. Now we are sitting at the 50-day moving average. The 200-day one sits at 78.22. So basically we're above all the moving averages here, the 20, the 50, and the 200 before the earnings report. Now we're going to sit just over the 20-day one. Of course, all of them are $1 difference. And so let's see if it holds on the 20. Maybe during the day we might turn green because, I mean, overall, the stock, yeah, if we zoom all the way out, it's back to prices not seen since 2016. And we know that since 2016, this business has grown, right? It's true that now there is more competition. It's true that their profitability profile is not as good as before. But is it a worse company today than in 2016? No, it's a company that generates even more revenue. Of course, they have to figure it out, right? From a profitability standpoint, they still have to figure it out. But should it be, our stock price, should it be as cheap as 2016? In my opinion, no. And even with the China risk, if that was truly the case, nobody's buying it because of China risk, then things like JD and Pinduoduo shouldn't go up either. And yet they go up because their business is doing well. So that's the whole thing. Sometimes the stock is just a stock. You have to look at the business. And for Alibaba, I will say the same thing again. I don't own it anymore. I mean, the business could be doing much better, but it's not doing so bad to be a stock worth $77, to be a company worth $185 billion. This is just my opinion. We know very well that if this was an European company or an American one, it would be worth 2, 3, 4 times more, let's be honest. But it is not. it is a Chinese one. So that's about it. That's the summary for this quarter. Do share your thoughts down in the comment section below. Are you buying? Do you hold? Did you sell? Let me know down in the comment section below. And I'll see you all in the next one. Bye bye.